Okay, so it says the Struder Partnership has total partners equity of 510,000, which is made up of Main Capital 400,000, Frisk Capital 110,000. The partners share net income and loss in a ratio of 80% to Main and 20% to Frisk. On November 1st, Madison is admitted to the partnership and gives a 15% interest in equity and a 15% share in any income and loss. Prepare the journal entry to record the admission of Madison under each of the following separate assumptions. First assumption is that Madison invests cash of 90,000. So if we're gonna record that this person invests 90,000 of cash, what journal entry needs to take place?
Cash and capital.
A debit to cash and credit to capital. So a debit to cash and whose capital?
Madison.
And for how much? Let's work out how we got that 90,000. What was the total net income?
510.
510,000, and you're obviously going to multiply that by what? 20%.
Give them 50%.
15%, and then what else? What else are you gonna, before you can actually multiply that 15%, what else are you missing here? Because that's not how you got 90,000. If that's net income and it's telling you that this person is coming in with what kind of capital? How much? 90,000. Don't you think you need to add that to the equity that exists? So 90,000, and that needs to be multiplied by the 15% to give us how much for this journal entry?
90,000.
What's the next assumption?
13,500.
What's 13,500?
The 90,000 times. Oh, it's
Plus
it's the
510,000.
entire all the equity.
Mhm.
The total equity.
Second assumption is that Madison invests $120,000 cash. Just looking at that, what can we honestly assume with that 120,000? Who is this going to be of benefit to? The partner coming in or the existing? Existing. Does everybody agree? Isn't 120 higher than 90,000? So that means more than likely it's going to be of benefit to who?
The existing partners, they're gonna be the owners.
Existing partners. Okay, so with that said, what is going to be our accounts to debit and credit here under that assumption?
Cash, Madison equity, and then
Tell me, debit this, credit that.
I would think cash is a debit, then the
Cash, we know, yes, is the 120,000 because that's what it said he invested, right? What else needs to be debited or credited?
Madison Capital,
Credited, debited.
credited,
Don't give me numbers, just tell me the account.
main capital, Chris capital.
And how are you gonna get these amounts for these accounts?
The first one, 510,000.
Okay.
120,000.
Right, because we have to take existing capital and add in what has been invested, right? Which gives us, and else, what else did we do here? Is that it? How much does this equal?
95,000.
630,000.
630,000. Now this is the new equity amount. What do you take with this 630,000? What do you do at that point?
Times it times
Times
15%.
15%.
630,000 times
94,000.
how much? Now with this 94,500, whose equity is this? Whose capital amount is that? Madison. So we can reasonably just go ahead and put that there. What's the next step?
Subtract it from
Subtract what?
the 94
from the total
From
capital,
120.
right?
from 120.
So we take our invested amount, we subtract Madison's capital of 94,500. How much did we get?
25,000.
25,500, and then we have to do what?
Divided.
Why?
That's equal.
Wrong. Read the problem again. They didn't say anything about they shared anything equally in there.
They shall at 80, 20.
They have a stated ratio.
So
Stated ratio 80-20. So
you multiply that times 0.20 and 0.80.
that's
to
it.
get the
That's
equal
it.
shares of
That's
how
it.
much
That's
they-
it. Keep it simple. That's it. 25,500 times 80. That's whose ratio?
Main.
Should be main.
How much is this?
20,400.
And whose capital is this?
No, why didn't you do that on number one? Add main and first.
Well, that's you're supposed to be able to tell me because I asked it earlier. When I was asking about the 120,000 of it being a bonus to someone. How much was existing in Maine's, not Maine. Oh, yeah, that's what it is. If Madison is investing $90,000, once you add that to existing equity, right? And then multiplied it by 15%, it gave you what? It's up here. Anybody can answer, come on. How much?
I'm sorry, I didn't hear what you asked.
Taking the existing equity of 510,000 and adding what was invested of 90,000 and then multiplying that by the 15% interest, how much did we get?
90,000.
90,000. So isn't that equal to what he invested? Come on, y'all, it ain't rocket science. Yes, it is. So that means that it's an even, no bonus to anybody, right?
Oh, when it's
That's why we
bonus.
recorded it simply cash and Madison Capital.
Oh, so when it's a bonus, cause Right, cause after it says with bonus.
Well, no, all I'm trying to get you to see is that we're doing the same process over and over again. We're taking existing equity and adding in whatever cash was invested. If once you add the invested cash plus the existing equity times the interest rate and you still come out to the same amount that you're investing, that's an even swap. It's not a bonus to anyone.
So you wouldn't credit no account.
No, you
It's
just
no
credit
money,
it.
it's nothing.
No, don't overthink it. All I'm saying is this is equal to this means it's straight. We receive cash and put this person in the partnership. That's all I'm trying to get you to see. Do I need to go through it once more?
No,
Sure.
Sure.
Positive.
yeah,
Fine.
Miss White, did that answer your question? No?
Yes,
Yes? Okay. Going back to this. 25,500 times what was this last partner's
20%,
20%? What's the amount?
5,000.
5,100. Do we balance?
Yes.
so all those should equal that 120,000.
120. Mm-hmm. Last assumption. And then after that, we just gonna take 5 minutes because y'all need it. Last assumption is that 80,000 was invested. So because you know what you know from number one, when it was an even swap, clearly 80,000 means that it's gonna be a bonus to who?
The person.
Not existing. The person
that's
coming in, the new
Yeah.
partner, right? So
So there's a loss for the so we're gonna.
how does it's the loss for the existing partners, but how does the journal entry, how do we reflect the journal entry?
You still debit cash,
Do you? What else?
and then you credit. Well,
You did it.
whatever losses you would credit, well,
It's not, you can't just say losses, it's not losses.
you would debit the accounts because you would debit capitals.
Who capital?
Madison and Chris for the amounts of.
I thought Madison was the one coming in.
I meant Maine and Chris.
Main and Fritz,
You
those are
debit
existing?
those as well. You debit the cash for the full amount, and you would debit their capital amounts for the amount of the loss, correct?
You asking me or telling me?
I don't know.
We gonna keep going through it.
Maybe break.
Yeah, you do. Everybody do. But
Yeah,
cash, Main, and Fritz debited. Why would we debit Madison?
because he's coming into.
Then what would you credit?
Capital.
You're doing all three of their capital accounts right here. If you saying debit all of them.
No, you credit capital.
You
Madison
debit
credit.
cash for how much you brought in, then,
I just need to know the accounts. Debit cash, debit Main, debit Fritz.
You credit Madison capital.
What's the amount of cash that you brought in?
80,000
80,000. So we can go through the same
procedure.
thing we did here for assumption 2 and find out their capital accounts. So existing equity was 510,000, correct? Adding in 80,000 gives us how much?
590,000
590,000.
times 15%.
Taking the 590 times the interest of 15% equals
88,500.
500. 88,500.
So yes, times 80%.
You hadn't gotten there yet. Why do I say you hadn't gotten there? What are you missing? 80,000 minus 88,500 equals how much? Negative what?
negative 8,000.
8,500. And that 8,500 times their ratios of 80% first is gonna give us how much?
6,800.
6,800, and what about 8,500 times that 20%?
1,700.
17. So you can bring those up here, right? Main's capital is gonna be how much? Who had the 80% ratio? Main. So we're doing 6,800 here. Frisk obviously was the 1,700, right? Madison capital is 88,500. Do we balance? I'll give you a chance to write that down. Please. So exercise 12-10 reads, Turner, Roth, and Lowe are partners who share income and loss in a 1-4-5 ratio. After lengthy disagreements among the partners in several unprofitable periods, the partners decide to liquidate the partnership. Immediately before liquidation, the partnership balance sheet shows total assets 126,000, total liabilities 78,000, Turner capital 2,500, Roth capital 14,000, and Lowe capital 31,500. The cash proceeds from selling the assets were sufficient to repay all but 28,000 to the creditors. A, calculate the loss from selling the asset. B, allocate the loss to the partners. And C, determine how much of the remaining liabilities should be paid by each partner. So the first thing we need to record is, or find out, is how much the cash proceeds are going to be from liquidating or selling the assets. And tell me, what did you do? How did you find out? How much did you sell it for, and what ended up being the loss overall?
You sold it for 98,000. If it was enough to cover everything except 28,000, so you would subtract 28,000 from 126,000.
Okay. So how much were they worth?
There was total assets were worth 126,000.
Okay. And the total liabilities?
78,000.
And obviously you just said we're gonna subtract that, right? And then we really didn't need to, but we know that all we couldn't pay was the 28,000, which the problem mentioned, right? So we can say liabilities in arrears is the 28,000. Now, how much were the proceeds from selling the asset?
98,000.
98,000.
From selling all the assets. It should have been that.
How much did they sell it all for?
They don't say.
It just says that it was enough to be paid.
All
They're putting
the 28,000. That's where I got the 98,000 from.
So
I subtracted it from the 126,000.
you subtracted what from 126?
The 28,000. All but what was left. They said they could pay. Oh, it should have been all the liabilities. Oh, okay, 78,000.
Well, really, you didn't even have to do that. They did that for you by telling you that it was 28,000 still in arrears.
So the proceeds was like 50,000.
Right. That's what I'm trying to get to. they told you that it was 28,000 left, right? That could not be paid. So that means if you paid everything but 28,000, the only thing that you could have possibly paid from that 78,000 was how much? 50,000. So if those are the cash proceeds, that means that we incurred what kind of loss? What kind of loss did you incur from the sale of these assets? I know y'all know how to count, and I know I can't. I told you to come in here with calculators. It's relatively simple.
I thought you were asking for words.
Yeah, that's all.
That's why I didn't answer.
What did I ask for? If I
That's what
said,
it
how much
sounds
did you how much of a loss did you incur?
Specific loss. Like, okay.
What's the amount?
28,000.
So what you want, 126 minus 50?
76,000. Thank you, Mr. Comey. Do y'all need another 5 minutes? We can't go the next couple of hours like this. Seriously. It's simple. Subtract. 76,000 was the loss on this sale. We clear about where that came from and what it is? I'm not asking you for words. 76,000 was the loss on the sale. In other words, they liquidated everything. All they got from it was 50,000, which is all they could pay towards that $78,000 debt, which left them with 28,000 unpaid, right? So the total loss that they incurred was 76,000 because originally they were worth how much? 126,000. Now, hopefully we can move on.
Oh, wow. I see.
Yeah, it'll do that to you. It'll do that to you. All right, so B is asking for allocate the loss to the partner. So we're talking about the 76,000 at this point. And they gave you what kind of ratio?
1.45.
So how do you think you're supposed to manipulate that? You had 3 partners, right? What were their names?
Turner, Ross, Lowe.
So you had Turner, Roth, and Lowe, and what were their balances prior to the liquidation, capital-wise?
Turner capital was 2,500.
Okay,
Roth capital was 14,000.
okay.
The low capital was 31,500.
All right, so we incurred that loss of 76,000. Their ratios is 145. Anytime you do a ratio, you have to put it over a what?
One.
Denominator, right?
Yeah.
So add all those up. 5 plus 4 plus 1 is 10. So that means you're going to do 1 over 10, 4 over 10, 5 over 10. So 76,000 times, no, 1 over 10 for Turner means he incurred how much of that loss?
$7,600.
What about Roth? 76,000 times what was it, 3 or 5?
4.
4 over 10. How much was his loss?
30,000.
30,000?
400.
30,400? And then lastly, Low,
38,000.
so that means now that we have each of their share of that loss, how much are their ending capital balances? For each of them. Turner, he had a positive 2,500 minus 7,600,
5,100.
negative 5,100. Raw 14,000 minus 30,400.
16,400.
Negative 16,400. Low 31,000 minus 38,000. I mean 31,500 minus 38,000.
7,000.
6,500.
Negative.
Negative 6,500.
Wouldn't it be 7,500?
You know, Miss White, I don't know, cause I'm just
38,000 or 30,000?
38.
Wouldn't it be 7,500?
Truth be told, I shouldn't be the one answering you. Your counterpart should answer you because I asked for the answer from you guys. So what is it? Is it 6,500
6,500.
or
6,500.
or what? What is it?
I calculated it.
31,500 minus 38,000. You still sold on the?
6,500.
Okay.
You got it. Okay, the last part of that problem, determine how much of remaining liability should be paid by each partner. What answer did you get? What should each partner pay?
Negative. Turner should pay 5,100.
Basically, anything that's ending in their capital balance, right? Whether it's a deficit or a positive. For all of them, it has been a deficit. So that's what each one is going to end up paying out. Exercise 12-11, using exercise 12-10 as a base. It says, assume that Turner, Roth, and Lowe partnership of exercise 12-10 is a limited partnership. What does that mean if it's limited?
They only have partial, like limited responsibility for losses.
Is that what LP means? That's not what limited partner means. What does limited partner mean?
It's the type of partnership designed to pay for business partners.
Don't you read that? We just went over this last week. What does general partner mean? The word general.
Did they take most of the responsibility?
Who takes most?
The general partner.
Exactly. I don't post these lectures on the front page for nothing. I'm getting on y'all today because I don't know what's wrong with you. I have no idea. We ain't had no break or nothing. I just saw you last Tuesday. We just went over it. I don't record that stuff and post it up on the front page for you not to be able to answer these kind of questions. Sometimes it just takes to go back and watch the lecture again, even if it's something that you don't understand or if you plan to not read the chapter again. General partner means that in the partnership, there's a general partner who is responsible for the majority of operations and making sure that it functions. And then the limited partner is the person who basically was the silent partner who put in money to the partnership. We understand, right? So if that is the case, in this case, they had three partners. Who was the general and who was the limited?
The general was Turner and Roth, and the limited was Roth.
Okay, so all they want to know is that remaining 28,000 that we couldn't pay. How much of it should be paid by each partner? Round amounts to the nearest dollar. Now, with that being said, what changes about what we did before? How does that change? When you're a general partner, how does it change how you share a deficit or how you share a gain in the liquidation of a business?
General partners equal and how much they share or lose?
Not quite.
So you wanna use the ratio?
We still gotta use those same ratios. The 1, 4, and 5. That doesn't change. However, what is happening with the limited partner?
They're decreasing.
Remember how I just explained to you what general limited means, right?
Mhm.
Who carries the bulk of the responsibility?
General.
General partner. So wouldn't it be only fair that Lowe, since he is the limited partner, will not incur such of a loss because he's a what?
Limited partner.
Limited partner. So that means that instead of Lowe incurring, instead of him paying his balance, who's gonna have to pay his balance?
Turner and Ross.
Turner and Roth, the two general partners. So that's how this changes. Is because it's being liquidated, because under any other circumstance, if it was not to be liquidated based on that, then it wouldn't be an issue. What is this, 10?
10, 11.
We know that the loss is how much?
28,000.
28,000. No. What's the loss on the sale? 76,000, right? So those same ratios again.
76,500.
When did it change?
What's up with what y'all put in the thing? Ross on sale, 76,400.
Mm-mm.
Mine says 78.
Yeah, 76,800.
That's what
Are we in the same room?
Yeah.
We can't be.
It is 76.
Right there. Oh, I thought that was a 500 right there. I'm sorry.
Three zeros.
Huh?
76,000,
Oh.
not 800. Going back to this one. Their ratios were how much? Turner. Is it Turner?
Yeah.
Raw and Low.
12, 11.
Hmm?
Example 12, 11.
12, 11. Thank you. Okay, so that was that 76,000 times 1/10. 76,000 times 4/10, and that's 76,000 times 5/10. Give me the amounts again. Negative how much for Turner? 5,100 for Turner. Raw?
16,400.
Low?
6,500.
And we said that these two partners have to soak up
The 6,500.
the 6,500. How are we going to distribute that amongst them?
Each one have an add to them.
What do you do?
It depends on the ratio, right?
That's it.
Oh.
Because we're still dealing with that. We can't just change the rule.
So you multiply the 6,500 times the 1/4 and the 1/10
One. Huh?
times the what?
Remember how before we added to get 10? If you only dealing with two partners now, it's not 10 anymore. What is it? 5. The 1 plus the 4.
Right.
So
So the 1/1/5.
6,500 times the 1/5. 6,500 times the 4/5. How much for Turner?
1300,
1,300, and then, how much for Roth?
5200,
5,200,
and it should both equal the 6,500, correct?
both, no.
No,
What do you mean both equal?
adding them together,
The two numbers should equal 6,500.
Yeah, because we started with 6,500,
yeah.
but that should be,
It should now
It
equal,
equals
it should now equal what they,
Yeah, it equals 6,500. The 13 plus the 52.
yeah, but where are y'all going with that?
I was just asking. I don't know.
Don't confuse yourself, because we're not even doing that. Don't do that. Don't do that. It equals the 6,500, not for them, but it equals Lowe's 6,500 that he could not pay or should not pay. So now, each one of their capital balances is what now?
the first one is 6,400.
You still need to count it, right?
Hmm.
Okay, yeah.
And the second one is 21,000.
Ultimately, his does what? Because they paid his debt. And so, of course, when it comes down to personal liability, how are they going to pay? What are they going to pay?
I don't know, you like 6,400, right?
Mm-hmm.
The other one, like 21,000.
Mm-hmm.
And one thing,
Right. Low has no personal liability. Last one, problem 12-3A, page 502. And I would have thought this one was on the homework, but I guess not. I don't know what I thought it was. Okay, problem 12-3A, Bill Beck, Bruce Beck, and Barb Beck formed the BBB partnership by making capital contributions of $67,500, $262,500, and $420,000, respectively. They predict annual partnership net income of $450,000 and are considering the following alternative plans of sharing income and loss. A, equally, B, in the ratio of their initial capital investment, C, salary allowances of $80,000 to Bill, $60,000 to Bruce, and $90,000 to Barb. Interest allowances of 10% on their initial capital investments, and the balance shared as 20% to Bill, 40% to Bruce, and 40% to Barb. This is really no different than what you've been doing. The only thing that's different is that last assumption C, they have actual ratios instead of sharing everything equally, like we've done in the past. So with the first one, they give you a table, how to label it, or what heading to use rather. And we're supposed to figure out how much is shared if they do it all equally. So if they're sharing it equally, what do we need to calculate?
Loss.
No.
Total amount.
If they're sharing equally, what are they sharing equally?
Income,
Which is
the net.
how much is it? So if they're sharing it equally, we need to divide it by what?
The rate, 150,000 apiece.
What's the second assumption? Somebody read it, anybody.
Prepare a statement of the parking.
Assumption B.
And the ratio of the initial capital investment.
So initial capital investments, they gave you those, right?
Yeah.
Yes.
Add all three of those capital balances up and tell me what the total equity is. How much is it? 750,000. And how much did Bill have in his capital account?
Bill had 67,500.
Thank you.
Bruce had 262.
262.
262,500. And then the last one had 42,000.
42,000.
420,000.
Thank you. All right, so calculate these. 67,500 divided by that 750,000, then multiply that by 450,000. Do that for each one. And tell me what amount.
Number 750,000 is everybody's capital. That is
That's the total equity.
investment.
Yes, everybody's total equity. Everybody's capital balance, like you said, everybody's capital balance added together. How much is it for Bill? Thank you. How much is it for Bruce?
$157,500.
Barb? Thank you. So just bringing those balances down, ultimately it should equal up to what?
450.
Yep. All right. What's the last assumption? Wake up, wake up. What's the last assumption?
Salary allowances of 80,000 to Bill, 60,000 to Bruce, and 90,000 to Barb. Interest allowances.
Hold on. So they get salary allowances. 80,000 to Bill, 60,000 to Bruce, 90,000 to Barb, which equal how much when you add all three of those together?
230,000.
Thank you. Subtract that from 450,000 net income. So 220,000 is the balance as of right now. And then they get interest, right? What's the interest rate?
10% on the initial investment.
So initial investments, I could just pull them from up here, 67,500 for Bill, 10% times 262,500 for Bruce, and 10% times 420,000 for Barb. What's the amount for Bill for interest? $6,750. Bruce,
26,250.
Barb,
42,000.
bringing all of these over is a total of what to be subtracted? 6,750 plus 26,250 plus 42,000. $75,000. And when you subtract that, how much is left? 75,000 from 220,000.
145,000.
And how is that 145 going to be distributed? What did they say in the problem? Okay, a little slower.
20%
the
to
bill,
Bill.
40% for Bruce, and 40% for Barb.
So 20% times 145, 40% times 145. Give me amounts for Bill. 29. Bruce.
58,000.
And wouldn't Barb be the same? Because they shared the same percentage. So we know all this equals out to 45,000. What are their ending, total shares at this point? And what you're doing is you're taking the salary allowance plus 60, plus the interest, plus the remaining, adding those up, these three numbers.
Bill would be 115,750.
Bruce.
$144,250.
And Barb. $190,000.
Even? What's the next part of the problem? What else do they ask us to do?
Yeah, all of that was just for number one. So, number two says prepare a statement of partners equity showing the allocation of income to the partners, assuming they agree to use Plan C. So Plan C was the one, all of this, well, this part was Plan C. That income earned is now 209,000, and that Bill, Bruce, and Barb would draw 34,000, 48,000, and 64,000 respectively at year end. So, how does that change? What changed? The only thing that really changes is the net income amount, right? And obviously they took withdrawal, so we have to account for that. But doing a statement of partners equity, do you have that in your book? Did you do this part of the problem? No. Did anybody do this part of the problem? Okay. How do we start off a statement of partners equity?
Title,
Well, besides that, what else do you start
the
with?
date, the name of the person in the date, like the period, like the ending period.
We can skip all that. 12-3A, continue. This is part 2.
Start off stating the capital.
Well, did any of them have beginning capital balances? Beginning capital balances should be what?
0.
Zero.
Yeah,
Zero.
their initial investments is their own money. But the beginning balance, everybody knows 0 before investments, listed before investments. But you have to list the investments on the statement.
So what were their investments? What was Bill's?
67,500.
Bruce,
262,500.
Barb,
420,000.
for a total of
750,000.
what was the net income?
450,000.
It changed, didn't it? 209,000, so that we know that's what we're trying to get to, right? Did they have the same salary allowances and all of that, or did that change too?
They said they were the same as C.
Same. So just tell me the numbers. That's all I need. So salary allowances, bills was how much? How much? 80,000. Thank you. What was the interest that we came out with? How much for bill?
29,000.
For interest?
Oh, sorry, 6,750.
Bruce,
$26,200 and 42,000.
Now, the only thing you're gonna have to calculate, obviously, is what at this point? What do you need to calculate?
Total net income.
Right. You know total net income already. What you need to do is find out the remaining, right? If we total this entire line up, what do we equal? 80,000 plus 60,000 is 140,000 plus 90,000 is how much?
230, right?
230,000. And then all of the interest, 6,750 plus 26,250 plus 42,000.
$75,000.
75,000. So this means what at this point? Mm-hmm. No, what are you subtracting these from? Which is
250.
209,000 was the new net income amount. So subtracting these two from 209, what's the negative balance that you get? 96,000. How are we gonna split this 96,000 deficit? Remember the same ratios? Didn't they do 20, 40, 40 split?
Oh, yeah, that's true.
So 20% times 96,000, 40% times 96,000, and 40% times 96,000. So how much for Bill?
19,000.
Negative. Bruce?
38,000.
Okay. Barb?
38,000.
Now that we have that, we need to find out their total share. Which is how much? For Bill, you got 80,000 plus 6,000, 750 plus or minus, yeah,
67,550.
67,550. Bruce,
47,850.
and Barb,
93,600.
you said 93? Okay, now that we have these, we also have to do a total what? Didn't they come in with investments? Didn't they invest money?
Yes.
So their shares plus what they invested.
I was like, how we get the share?
Huh?
How we get the
It's the same thing we've always done, add allowances plus interest plus whatever their share of remaining income is. So 67,550 plus 67,500,
$135,050.
135, 50. Bruce,
310. 350.
Barb,
$513,600.
513,600. All right. Now that we have their totals, what else do we need to do?
Withdraw.
The withdrawals. Uh, Net income 209 because it's ultimately what this is supposed to add up to. And 209 subtracted from the 750,000, which was the total equity invested, gives us how much? I'm sorry, plus 750,000 plus 209,000.
959,000.
All right, so the withdrawals were how much for Bill? How much was it for Bill? It stated it in the problem. 34,000. How much for Bruce?
48,000.
48,000.
4,000.
64,000. Which means that their ending capital balances, all of these added together give us what? 34,000 plus 48,000 plus 64,000.
$146,000.
And I know it's other people in this class. Please give Mary a break. What are the capital balances for Bill, Bruce, and Barb ending? $101,000. Even.
$50.
How much for Bruce?
$262,350.
Barb?
449,600.
And then 959,000 minus 146,000.
813,000.
Y'all made me tired. Literally. What's is anything understandable or not understandable about this part?
Where'd you get 209 from right there? Is that because you added those?
Stated in the problem, that's the new amount of income.
No, I know I up there. I'm trying
That's
to
the
like,
same number.
yeah, so you just moved it.
No, I didn't move it. I put it up here for your illustration
Okay.
because truthfully, I could have just put it down here. We were trying to get here. So I put it up here so you can see it the normal way that we've been doing it by subtracting it from the income. But normally I would have just put it down there.
And that line is the interest line?
Total share.
Okay, oh, sure. Okay, that's all.
That's why I put that arrow up there. Total share. Okay. Everybody understand everything else? No? Yes. I guess I'm talking to the wall. Okay. What's the last part? Yes, sir. Because it's a statement, yeah, you would need to put that line. Cause they asked you to do an actual statement of partners' equity. If you were doing this on the homework, you couldn't just not put that line in. What's part 3?
Prepare the December 31st journal entry to close income summary, assuming they agree to use Plan C, and that net income is 209,000. Also close the withdrawals account.
So you're doing the closing process at this point. What's the first journal entry that you need to record?
Income summary,
Income summary and what?
and next will be the capital.
What do I debit? What do I credit?
Debit income summary,
Uh-huh. Credit,
capital account,
which are?
bill, debt, or
So what's the amount that we record?
would it be income summary 813,000?
Why do you think 813,000? What amount did they tell you to use?
Oh,
209,000?
Oh, yeah.
So what would be these capital account balances?
What ratio?
Explain. You can, because you just said it to me. It's not called ratios, what's it called?
dollar amount.
So, how much is it to bill?
19,200.
No. You're not using ratio, where did you get that from?
I'm gonna just use the total share and not
What's the total shares per bill?
135,000.
No.
Oh, 67,000.
550. Bruce,
47,850.
Barb,
92,600.
does it balance?
Yes.
All right. What's the next journal entry? We just closed out income summary, what else we gotta do? Okay, so what do I debit and what do I credit? It's gonna be the same as the what? What do you close withdrawals to?
Summary, income summary?
Oh, right, this is going all the way back to financial account 1, you're just using 3 people's capital accounts now, that made me question where you took, when you took financial account 1. However, what do we debit, what do we credit? What's the normal balance of withdrawals?
What side?
Yeah.
Debit. So to close it, you gotta do what? The credit.
Credit it.
So what
You're
do
gonna
we
debit
debit?
the capital.
Which capital, folks? Be
Bill.
thorough. Bill vet capital.
Bruce capital and Mark capital.
What do I credit?
You're gonna credit business loan, business card, Mark card.
What's the amount?
34,000 for Bruce bill, 48,000 for Bruce, 64,000 for Mark.
Was that the last problem? The last one? Yeah.
Yeah.
15 minutes, come back by 11 o'clock, so we can go over, chapter 13. It's now 10:45.